Hey now, in the 18th century, French mathematician Paul Lévy proposed the martingale strategy based upon the assumption that the win-loss outcome of each setup is independent of each other. This theory, which can apply to many realistic situations such as trading, postulates after each loss you are to increase the amount risked. How does this system compare to the standard fixed amount that most traders use? I am going to test this theory with a profitable trading system on real charts to find out, and be sure to stay tuned to the end where I will compare the data between the martingale system and a standard risk deployment of 2% per trade. If you want to see more content like this, press that subscribe button like this French bulldog says hello. I call this trading system the Martingale Classic, and like most trading systems, it can be applied to Forex, crypto, options, stocks, indices, or any instrument that has significant volume and market participants. This strategy uses 3 free TradingView indicators. As always, links and settings to all indicators are listed in the description. The first indicator is the Moving Average Convergence Divergence, or MACD. I am going to keep the inputs at default, but make the lines thicker so you can see it more clearly. The MACD is one of the most useful indicators in trading, and in this system, we are going to use it for our entry trigger. The second free TradingView indicator is the 200 period exponential moving average. The length is set to 200, and I'm going to color it in white. This study will provide us with our overall trend direction. The final indicator is the average true range bands, set to 2 times the ATR for the upper and lower levels. The ATR calculates previous volatility to draw lines above and below the price. We are going to use these bands to set our stop loss and take profit levels. Let's go over entry criteria and review some examples. As always, system rules and details are listed in the description below. This chart is Euro versus the US dollar 1-hour candles. You may recognize this trading system as the classic MACD strategy. I am going to run through some extra examples to demonstrate how the martingale system works with this very famous trading system. The rules to enter along on the classic MACD are: first, price must be above the 200 exponential moving average. Second, the MACD must cross up below the zero line. All of that happens on this candle here. That is our trigger candle. We place our stop at the ATR band below the trigger candle and target 2-to-1. And on our first trade, we are going to be risking 1%. And this one hits our 2-to-1 target, and our account is up 2%. If you enjoy this content, make sure to click that like button. Here is the next long example. Price is above the 200 EMA. We get a cross up of the MACD below the zero line. This is our trigger candle. Our stop is placed at 2 times the ATR, and we target 2-to-1, risking 1%. And this one stops out. So we deduct 1% from our balance of 2%, and now we are up 1%. But according to the martingale system, we are going to increase our risk after a loss. So for my test, every time we lose, we are going to risk another 1%. Let's continue. We have one more long example. Price is above the 200 EMA in white. We have a cross up of the MACD from below the zero line. This is our trigger, and remember to always wait for the candle to close. We place our stop at the bottom of the ATR band and target 2-to-1, now risking 2%, and this one stops out. So now we lost 2%, and our account balance is now minus 1%. Let's take our account balance and flip to shorts. This is what I will test for shorts. First, price must be below the 200 EMA in white. Second, the MACD must cross down while above the zero line. This is our trigger. We place our stop at the ATR band above the trigger candle and target 2-to-1. And because our last trade was a loss, we are going to add 1% to our position. So here we are going to be risking 3. And this one stops out. Now our account balance is negative 4%. Here is our next short example. Price is below the 200 EMA. We have a cross down of the MACD from above the zero line. This is our trigger candle. We place our stop at 2 times the ATR of the trigger candle and target 2-to-1. I am going to add another 1% to our risk from the previous losing trade. So on this setup, the risk will be 4%. And this one hits our target of 2-to-1 for an 8% gain. And now the account is up to 4%. I'm going to show you one more quick short example. Price is below the 200 period EMA. We have a cross down of the MACD from above the zero line. This is our trigger. We place our stop at the ATR band above our entry candle and target 2-to-1. And now that our last one was a winner, we reset our risk to 1%. And this one hits our 2-to-1 target, making 2% on this trade and increasing our account balance to 6%. Stick around to the end where I reveal which system produced better results, the martingale or a fixed risk of 2% per trade. And now it's time to do what I do. If you enjoy this content, hit the like button. Remember, this is just 100 tests on one instrument. If you are thinking of using the system, don't, and I will explain why shortly. So this test was done on the euro versus the US dollar 1 hour candles. It took 18 months to find the 100 setups. Most wins in a row was 5 and most consecutive losses was 6. The test ended up with a 48% winning rate for an amazing 154% gain on account. So on this equity curve, you can see the clear effects of the Martingale system. We get these 3 smooth drawdowns created by the increased risk after a loss, followed by choppy moves up. What score would you give this strategy? Let me know in the comments below. I give this system a Trader's Landing score of 1 due to the theory of stopping time, which I will explain in a moment. There are 4 interesting points about this system that I would like to share. First, if we took the same setups risking 2% per trade, the gain on the account would have been 88%. So on this data set, the Martingale system, starting at 1% risk per trade, almost doubled a 2% fixed risk system. The next interesting nugget is the difference between equity curves. As expected, the drawdowns are less intense using a fixed risk amount. However, the comparison of upward impulsiveness is not displayed well on these graphs, as the Martingale system almost doubled the standard method. Furthermore, looking at the classic MACD strategy without taking into account position sizing, you can use the half trend indicator like I featured in this video to use a dynamic take profit system. Look at this chart where using the half trend buy signal gets us out of this short with a fantastic 7.62 risk versus reward. Again, this has nothing to do with the Martingale system, just an optimization tip for the classic MACD strategy. So here is the big warning on this system. According to Joseph Dube's optional stopping theorem, there is an impossibility of winning over the long run. This is due to the given limit of position sizing, assuming you do not have infinite funds. So basically, if you use this system long enough, you will dwindle your account to 0. Of course, Dube's theory postulates doubling the amount risk with every loss, but the way I did it will give you more wiggle room. I still do not recommend this system in any way, shape, or form. Check out this playlist for more profitable systems, and have a great day because you deserve it.